Back on the Young Turks. Now we're going to talk a little economic policy with Dean Baker. He's the co-director of the Center for Economic Policy Research in D.C. Dean, welcome back to the Young Turks.
Have me on.
We appreciate you coming on. So the ABA, the American Bankers Association, had their annual convention, and apparently there was a showdown. What was that about, Dean?
Well, this is a protest by a group of community groups. You had labor unions buying consumer groups. And the idea was to say people are unhappy with what the banks have done and the way they're being treated by Congress, largely getting their way, at least I would say, on regulatory reform. I mean, we're suffering a horrible disaster because of the conduct of the banks. The banks made a lot of money in the years 02 to 06, 07 as the housing bubble was getting ever more out of line, growing ever larger. They were making money hand over fist, and now that's collapsed. And as a result of that, we have almost 10% unemployment. There's another 5 million people who are working part-time with full-time work. We're losing 2 million homes to foreclosure every year. And the banks are up on their feet and reporting record profits. And, this doesn't make sense. It's not fair. And you had people in Chicago saying they don't like this. They want it to change. They want Congress to hear them and to have serious regulatory reform and for the banks to change their practices.
Dean, we were just talking fairly recently with Dan Gross of Newsweek about this, and so Ken Feinberg comes in and cuts some of the compensation at some of the banks that still have TARP money. But to me, it seems like that's the wrong way to go about this. That what we really need is structural change, and not to just come in and erase a couple of numbers every once in a while. And so I've got to ask you, do you think Obama administration is taking any meaningful steps towards that structural change?
I'm afraid they're really not going anywhere near far enough. I mean, basically, we have a badly bloated financial sector. And the analogy I make here, finance is an intermediate good. I mean, this isn't like, health care. We have a wasteful health care sector, but at least it provides a direct service. So health care, food, I mean, we could all think of these things, where we benefit from them. No one benefits directly from finance. Finance is an intermediate good. It's like trucking. We need trucking to get, goods from point A to point B. But we don't benefit directly from trucking. We benefit from having the goods at point B rather than point A. Same with finance. We need finance so that when we want to take out a mortgage, we can go to our bank, get a mortgage. When we want to get a loan for our kids' education, we want to put money aside for our retirement. It's an intermediate good. In principle, we'd like to have the sector be as small as possible. That would mean it's efficient. But instead, it's exploded. It's quadrupled relative to the size of the economy over the last 3 decades. That's a bloated sector. If that happened in trucking, imagine that we had 4 million people employed in trucking instead of 1 million. Any economist, anyone in their right mind would say, what's wrong? We have a bloated trucking industry. Well, we have a badly bloated financial industry, but the people in Washington, unfortunately, including the Obama administration, aren't prepared to crack down on it. And that's a really big problem.
So, before we go on with what the right solution should be, I tend to think that the reason that it has gotten to this unbelievable proportions is because of derivatives. I really think that's an enormous part of the ballgame here, and that people talk about it as if it's a part of the puzzle, but to me it seems like it's, maybe 90% of the puzzle is too much, but close to that. I mean, you don't get to tripling the size of an industry by changing a couple of things around the edges. They do it by doing unregulated gambling, which is what the derivatives are.
Well, derivatives are certainly a part of the story, and a big part of the story. But, even if you look at something old-fashioned like stocks, we're trading stocks at, maybe 20 times the rate we did 20 years ago. So it's not just derivatives. It's really everything. And,
talk about that for one quick second, Dean. Sorry to interrupt you. Why are we trading stocks at 20 times the rate that we were 20 years ago? There's obviously an explanation for that.
It's cheap. It's real cheap. 20 years ago, we didn't have the computerization that we did today. So now you could trade stocks, computer programs could trade them, hundredth of a second. Back 20, 30 years ago, in the early days of computerization, you had to have a person that would plug in the trade. It would be a trade on the stock floor. So we've reduced the cost of carrying on a trade, and as a result of that, there's much more trades. They're traded, people buy stock 1 minute, in some cases sell it the next, literally.
Does that help the financial industry more? Does that lead to them getting bloated, or is that a small part of it?
That's a big part. That's a lot of money. Every trade, someone's making money on it. They're making money on the transaction. So I don't mean someone is necessarily profiting on the trade itself, right, in the sense that, I buy Exxon at, 100 and can sell it for 101. Maybe I can, maybe I can't. But by virtue of the fact that I bought it at 2 o'clock and I sold it at 2:05, there was someone in the middle of that who charged me a commission, and they made money.
So that's part of the reason that the financial industry got big. What are some of the other reasons?
Well, there's been a huge amount of deregulation, so there were all sorts of controls on the industry, recognizing that this is an industry that is very dependent on the government. I mean, we have deposit insurance, for God's sake. You know, these guys like to go out and say, "Oh, get the government out," and go, "Okay, we'll take away your deposit insurance." They go, "You can't do that. Of course it would collapse." You know, so basically they want the benefits of government protection, but they don't want any regulation. So deposit insurance. You know, they're too big to fail. This is one of the issues that I and many others have been raised. Certainly was raised in the Showdown in Chicago protest. You have banks that everyone knows the government will not let them fail. Goldman Sachs, if they do something really stupid and they sink the bank, well, everyone knows it won't fail. What that means is that if I'm an investor and I've got $50 million to lend somewhere, well, I could look at Goldman Sachs and go, well, you might be doing stupid stuff, but if you get in trouble, I know the government's going to bail you out, so sure, I'll lend you $50 million. So they benefit hugely from all forms of government protection, and that allows them to get bigger, take big risks, and they end up putting the money in their pocket, and when things go bad, of course, we get stuck with the bill. We're
talking to Dean Baker. He's the co-director of Center for Economic Policy Research in D.C. And, Dean, of course, now we get to the issue of what do we do about it?
Well, one of the things I would love to see us do, and this is getting some traction here finally, is to have a modest tax on financial transactions. I was talking before about how the cost has gone through the floor. So if I want to trade shares of stock or futures or options, the cost of doing that has plummeted in the last 3 decades. Now, suppose we had a very modest tax, something like 1/4% on a stock trade. That's what they have in England. They've had that for years. We could do that. We could have a tax of, let's say, 1/100th of 1% on trading an option or a credit default swap. Could raise an enormous amount of money. We could raise around $100 billion a year. In fact, probably a lot more than that. And for most people who are using the financial markets for their normal purposes, I want to buy stock because I'm going to use it for my retirement or my kids' education, barely be noticeable. But for the people who are buying stock at 1 o'clock to sell it at 1:30, that would be a big deal. So we're going to discourage a lot of that trading. We'll discourage a lot of speculation, and we'll get the financial industry back down to a more normal size, and in the process, raise a ton of money.
Is there any hope that you go in there and go, you know what, Goldman Sachs, you're officially too big to fail, so we're going to chop your ass up?
Well, I think that should be done, and again, this is something that, 2 years ago, 3 years ago would have sounded like it was Looney Tunes stuff, but Paul Volcker, who was former head of the Federal Reserve Board in the 80s, a very well-respected figure, he's calling for exactly that. Alan Greenspan, not my hero, but again, a very prominent figure, he's called for exactly that. Sheila Bair, who's a very articulate, very impressive woman, head of the Federal Deposit Insurance Corporation, she's called for exactly that. So, in fact, I should point out she was also a Republican. She was appointed by George W. Bush. So you've had a lot of people, including many from, even the conservative side of the political spectrum. I was debating someone from the Manhattan Institute, a very conservative think tank in New York a couple of days ago. Agreed with me completely. We should not have banks that are too big to fail. So if I had to place money on it, I wouldn't say it's going to happen, but on the other hand, I don't think it's out of the blue now. It's a possibility.
I would definitely bet money against it. Sure, Sheila Blair, great. She's part of the administration in some way. But I don't see Obama with anywhere near the courage or inclination to go.
So you're going to have a lot more showdowns in Chicago. There were 5,000 people or thereabout came out for those protests. You're going to need that lots of places. You're going to need that in New York and San Francisco and Atlanta. You're going to need a lot of that. You're going to need people calling up their representatives in Congress. Look, people are really, really pissed. This is outrageous. People are unemployed. People are losing their homes, not because of anything they did, but because of things that Citigroup and Goldman Sachs did, and that's really outrageous.
So, final question on that, Dean. How would you do it? And I literally don't know the answer to that question. How do you break up Goldman Sachs so that they're not too big to fail?
Well, it's not too hard. You tell them to come up with a formula. You say, look, we want you to tell us how you're going to break up into institutions. In many cases, the big banks like Citigroup just merged with several banks. Wells Fargo bought up Wachovia. So it wasn't that long ago in many cases that they became these super large institutions. But you just say, you give us a plan, so you're going to break yourself up into 2, 3, 4, 10 banks, whatever it might be, or we could say each of those is not big enough to fail, too big to fail. And, if we don't like your plan, we'll come up with our own. And they have a good interest then in coming up with a good plan because, obviously they'll be hurt if you have government bureaucrats doing it rather than the smart people at Goldman Sachs who are presumably going to do it in a way that maximizes the profitability of each one.
All right, we're out of time. Dean Baker, Center for Economic and Policy Research. Really appreciate you joining us on the Young Turks.
Thanks a lot for having me on.
All right, we'll be right back, Young Turks.